Every investor dreams of finding that one stock that explodes in value, the next Tesla, Amazon, or Nvidia. But for every company that skyrockets, hundreds quietly fade into obscurity. The allure of high risk, high reward investing lies in the possibility of extraordinary returns, yet it also carries the danger of substantial losses. To navigate this landscape wisely, investors must balance ambition with analysis, emotion with evidence, and short term excitement with long term perspective. Understanding what separates a speculative gamble from a calculated opportunity is the key to building a portfolio that thrives in the unpredictable world of high growth investing. The first box to check when searching for high risk, high reward stocks is innovation with scalable potential. Companies that lead transformative change often deliver outsized returns because they operate at the intersection of technology, consumer behavior, and market disruption. Take Tesla as a case study. In 2010, when the company went public at just $17 per share, few believed electric vehicles could challenge the dominance of traditional automakers. Yet, by 2021, Tesla's market capitalization surpassed $1 trillion, transforming the company into a symbol of what innovation-driven compounding can achieve. Similar stories can be found in early-stage biotech firms developing groundbreaking treatments, fintech startups reinventing banking, and renewable energy companies pushing the boundaries of sustainability. Innovation alone, however, is not enough. Many high-concept companies fail to execute. For example, during the dot-com bubble of the late 1990s, thousands of internet startups promised revolutionary products but lacked viable business models. When the bubble burst, the Nasdaq fell nearly 78% from its peak, erasing trillions in market value. The survivors, such as Amazon and eBay, shared a common trait: scalability. They possessed not just an innovative idea, but also a business model capable of expanding profitably. A product or service that can reach millions without proportionally increasing costs is the hallmark of scalable innovation. Investors who identify companies positioned to grow efficiently often find themselves holding long-term winners rather than short-term hype. If you are still watching, kindly subscribe to the channel, like, and share this video. The second box to consider is financial resilience and cash management. Even the most innovative companies need strong fundamentals to survive volatility. Startups and growth companies often burn through cash before achieving profitability, which makes liquidity and funding access crucial. According to data from CB Insights, roughly 38% of startups fail because they run out of money. In an era of rising interest rates and tighter credit markets, access to capital becomes even more important. Investors must look for companies with manageable debt levels, positive cash flow trajectories, and flexible financing structures. For instance, NVIDIA's early success wasn't just about innovation in graphics processing. It was also about disciplined financial management. The company invested strategically in AI and data center technology while maintaining a healthy balance sheet, which allowed it to weather industry downturns. Conversely, WeWork's collapse in 2019 serves as a cautionary tale. Rapid expansion without financial discipline can destroy even the most promising ideas. Investors should always ask, does this company have enough liquidity to sustain growth if the economy slows down? And is it spending capital in a way that creates long-term value or just chasing market momentum? The third box to check is leadership vision and execution capability. Behind every successful high-growth company is a leadership team that can turn ambition into action. Great ideas require execution, and execution requires discipline, adaptability, and foresight. Elon Musk's ability to push Tesla and SpaceX beyond conventional limits stems from a relentless vision paired with an understanding of technology, branding, and scale. Similarly, Apple's resurgence under Steve Jobs and later Tim Cook illustrates how leadership continuity and operational excellence can sustain innovation over decades. Investors should look for leaders who demonstrate clear communication, prudent risk management, and a track record of delivering results. Companies that maintain transparency with investors, set realistic milestones, and execute consistently tend to outperform those driven by hype or short-term speculation. Research from Harvard Business Review shows that firms led by high-integrity visionaries, leaders who balance innovation with operational grounding, deliver up to 30% higher shareholder returns over a decade compared to peers with erratic management practices. It is equally important to recognize that high risk doesn't automatically mean high reward. The relationship between risk and return depends on how well that risk is managed. Diversification remains the cornerstone of smart investing. Allocating a small portion of a portfolio, perhaps 5 to 10%, to high risk, high reward opportunities allows investors to pursue outsized gains without jeopardizing their entire financial foundation. As Morningstar notes, portfolios with balanced exposure to growth and value stocks tend to outperform purely speculative portfolios over the long term, precisely because they can withstand market downturns. Investors should also understand the psychological aspect of high-risk investing. The emotional roller coaster of seeing a stock surge 40% in a week, only to crash the next, tests even the most disciplined investors. Behavioral finance research by Nobel laureate Daniel Kahneman highlights that losses feel twice as painful as equivalent gains feel pleasurable, a bias that leads many investors to sell winners too early or hold losers too long. To succeed in high-risk, high-reward investing, emotional control is just as important as analytical skill. Setting predetermined sell points, maintaining a long-term perspective, and focusing on fundamentals rather than daily price swings are strategies that protect investors from impulsive decisions. High-risk, high-reward investing can be incredibly lucrative when approached intelligently. Investors who check the right boxes before investing in companies like Netflix, Amazon, or Nvidia saw life-changing gains. But they also accepted volatility, uncertainty, and the patience required for compounding to take effect. The path to identifying the next breakout stock involves more than chasing headlines or hype. It demands critical thinking, due diligence, and a willingness to evaluate both the opportunity and the risk with equal weight. In conclusion, the search for high risk, high reward stocks should always be guided by three principles: innovation with scalable potential, financial resilience, and visionary leadership. Together, they form a framework for identifying companies capable of not only surviving volatility, but thriving through it. High returns come to those who embrace risk intelligently, diversify strategically, and stay patient through the noise of market cycles. The challenge is not just finding the next big stock, it's having the conviction to hold it through uncertainty while maintaining discipline and perspective. True wealth in investing comes not from speculation, but from aligning risk with knowledge and ambition with strategy. Subscribe to the channel, like and share the video. See you in the next one.